Every global six-figure entrepreneur eventually asks the same question. Which bank is the best? Which account is the best to move your money? And which bank actually is the best to hold your capital and your treasury? And more importantly, in today's banking environment, which combination doesn't freeze you or blocks your transfers of funds without any warning and stops your entire business operations? After opening over 600 bank accounts for offshore and high-risk structures with my team here at Redomiciled, I can tell you one thing. The solution isn't finding one single bank account. One bank account alone will not protect you in 2026 in this modern compliance environment. Not many people know this, but regulators and the free market have fragmented banking into different risk tiers. One single institution to hold your treasury, as well as operational transfers and potentially even using it for high-risk transactions, is an accident waiting to happen and a financial nightmare. Wise, for example, freezes you on everything with a crypto origin. HSBC, UBS, DBS, all of these tier 1 banks freeze you on velocity mismatches. And Revolut freezes you if their AI sees that your transaction pattern does not match your declared occupation. All of this can happen while you're breaking zero laws and you're just normally running your business as every day. In July 2024, Mercury added Ukraine, Nigeria, Pakistan, Croatia, the Philippines, and roughly other 30 jurisdictions to their unsupported country list, with closures effective on August 22, 2024. No individual appeal, and everyone transacting with those countries got flagged and put into a higher risk category and off-boarded. You then have 30 days to actually withdraw the funds from your account, and you can't take any more payments from clients into your account. The accounts got closed because their partner, Evolve, which is the underlying partner bank, decided that those geographies carried out too much risk, so it wasn't even their decision. This is the fintech world. You think you're banking with Wise or with Revolut or with Mercury or whatever EMI you're using, but you're basically depending on a banking partner underneath that can just simply change their risk appetite at any given moment. Here's what most entrepreneurs do not realize until it's too late. Having only one bank account means one compliance algorithm flag is enough to destroy your entire operational cash flow. One freeze locks your entire treasury, and one partner bank's decision ends your entire ability to do business and move money completely free through the financial system, and you're in a horrible position as an entrepreneur and business owner. But what if your capital was actually spread across multiple institutional grade layers? Or what if one account gets closed or frozen and it doesn't even impact your business anymore? That's the end of banking anxiety, and that's what happens when you stop searching for the one best bank and you're actually building a structure across your banking for your business and your offshore structure that has institutional grade. Your treasury sits untouched, your operations keep running, and your capital stays protected at all times and moves freely throughout the financial system. In the next 10 minutes, I'm going to give you an exact simplified blueprint with an example of two institutions that everyone knows and that shows you how you can create this architecture by yourself. I'm going to show you the right way of approaching this and how you should think about this and how you can separate high-risk inflows from actual treasury management and from operational business. We have a system that we put in place for our customers to actually manage aggressive compliance departments in today's world if you're a global business owner. And if you stop being a victim of the banking system and start using this approach, you'll actually have a banking system at your fingertips. This is how, and if you use the structure correctly, how you stop being a victim of the banking system and at their mercy, and how you can actually start using it at your advantage. So banks don't really see you as one person with one account. They only see patterns and clusters. So transaction clusters, risk clusters, jurisdiction clusters, and they always try to put you into those. You see, your account gets assigned a risk score based on where the money originates, what industry it actually touches and how you do business, and where these flows come from and who you're transacting with. A single transaction that doesn't align with that score that you've been given and that doesn't really fit into that cluster triggers a review. The compliance algorithm doesn't really hesitate. It doesn't say, it's probably nothing, but it's actually just automatically detecting a pattern, and your account goes on hold until you have explained and given the documents in order to release the money again. And this trend of de-risking inside the banking system is happening everywhere. So when we see crypto to bank transfers, or we have high velocity international payments that you might be doing, or they see invoices from jurisdictions that the compliance team doesn't really like, or they don't see it very often, or it just doesn't really suit your nature of business, they rather offboard you without any explanation because it's simply cheaper for them. So this means when the algorithms detect this inconsistency because it's not humans anymore, then your accounts get flagged, seen as a high-risk account, and you're offboarded. Another risk is changes in the underlying banking partner. So what do I mean with that? In July 2024, Mercury updated its banned country list to countries like Ukraine, Nigeria, Pakistan, the Philippines, but even EU countries like Croatia, as well as additional 30 countries. And on that day, they have simply decided to offboard these countries. And if you were in those jurisdictions or you were dealing with those jurisdictions, you had 30 days to empty your account and you could not do business anymore. The thing that people are missing is that Mercury actually isn't a bank. It's an EMI, a so-called electric money institute, and the actual banking relationship sits underneath that by a partner, in this case, Evolvi Bank and Choice Financial. The moment these partner banks decide that certain geographies carry too much risk or they don't really want to serve them anymore for a financial reason, then you're simply having to offboard immediately. And it's not necessarily the choice of Mercury because they obviously want to keep these customers, but the banking layer underneath and the license that they're operating on is more important to them, so you don't have a choice and they don't have a choice, and this is how the entire fintech world actually works. Wise, for example, runs US dollar accounts for Community Federal Savings Bank. Revolut actually has their own banking license now in the EU and the UK, so that has recently changed. But what actually matters is that the back end is the same thing and that they still rely for the majority of their offer on other banking partners. What you need to understand is on which banking license you're actually operating on in order to understand what the risk profile is and which transactions you can do on those banks and which ones you can't. The compliance reality is often a lot more specific than people actually realize. Banks aren't really freezing accounts because you're moving illegal money. They're like freezing your account because you're simply too expensive to look into because you have very small transactions and you're outside of the norm, and then it's just too expensive for them to actually look into that because you're not making them that much money, and therefore it's easier to just simply offboard you. So let's say your income source looks untypical, that you've declared on your occupation or your nature of business, or you're sending to countries that they don't really like, that are a bit more exotic, or you have certain business documents which are missing. Then the algorithm, they flag those situations and these inconsistencies which are outside of the normal distribution, and that mismatch leads to an immediate offboarding and freezing of your account. And this is why diversification matters. There's a saying, the only free lunch in finance is diversification, and having only one account is financial suicide in today's business world if you want to be competitive with your structure or your global business. Instead of thinking which bank account is actually best, you should start thinking about which institution handles which type of transactions and then start using them in your favor. Different money serves different purposes, and a different institution tolerates a different risk profile. And therefore, smart entrepreneurs, they don't just use one account. They use different types of accounts for different operations and for different transactions. So the core accounts that you need to start with as a base layer are tier 1 banks, which have deposit protection and that are in a geography that you actually want to hold funds in and where you hold your treasury or your main personal money. So these are banks like UBS, DBS, HSBC, Bank of America, JP Morgan, and so on and so forth. The purpose isn't really the features or the speed. The purpose is that institutional credibility that you get when you bank with those and when the money sits in those accounts. Those banks are seen as tier 1 banks, and they typically have a very strong fortress balance sheet, deposit protection, and they are too big to fail, meaning that if something very bad would happen, it's very likely that they're being bailed out, like in 2028, and your money is actually safe. What matters is what happens when your money moves out of this treasury account. When a wire transfer originates from UBS or any of these banks I've just mentioned, another bank sees them as a tier 1 origin. So that means that that money carries that institutional weight and credibility. So banks trust more established older banks. So when you're, for example, now sending a large transfer to your personal account or you want to buy real estate, it's a lot better to do that from a tier 1 bank rather from an EMI. So you're basically leveraging that institutional trust and the increased compliance to establish credibility on arrival when you need it. So you're not using it as an account for daily operations. You're not invoicing your clients from it, that's for sure. But you're building a history here that later on gives you access to that institution, that gives you a great banking relationship with those banks and that open you doors. And later you could even potentially get credit lines from that relationship that you're holding with this bank. So layer 2, after you have that account, are the operational accounts. And let's use the example that everyone knows. You can use Wise Business or Revolut Business. And this is where actually the transactions happen in your business. So you run your payroll, you invoice clients, you have global transfers with those multi-currency rails because they are actually very cheap and very efficient and you can move money very easily. Daily payments are perfect here because you have access to local rails like ACH for US, you have SEPA for the EU, you have CHAPS for the UK, and so on and so forth. So this allows very cheap, overnight, quick transactions, which are good for your business and for your customers. But you want to keep that balance relatively low so you can run your daily operations, but not really more, because these are accounts which everyone can onboard very easily, and therefore they have very, very small triggers for freezing your money and having these controls. So very quickly, one account can go down and you're suddenly having all of your money frozen and you can't operate anymore. And therefore you want to have the majority of your money in those tier 1 accounts and only use these cheap accounts like Wise and Revolut for day-to-day business. Also, as you receive and send a lot into those accounts, the likelihood is pretty high that one of these transfers actually gets flagged. So Wise, for example, they flag for crypto origin transfers or sudden volume spikes without really having the supporting documentation with it, or other transactions from parties that are seen as higher risk and you can't really know who that is just yet. Revolut has similar triggers, so we don't really need to get into that. But the main idea is that those accounts are designed to move money and not to hold it. The final layer is for what the other 2 layers should never touch. Crypto inflows, for example, or other transactions linked to higher risk industries. So payments from offshore clients in jurisdictions or from stakeholders that could potentially have a higher risk score because of either their nature of business or where they're from, those should never go into the same accounts. Global consultancies, alternative healing, gambling, you name it, all of these are seen as higher risk industries, and those should go into specialized banks in the EU, Caribbean, Latam, Georgia. Doesn't really matter where, we have a big offer from them, but what's important is that they actually support this higher risk structure. So the fee structure that you pay on these high risk accounts is often 2 to 5 times higher than standard banking. But you're really just paying for protecting these other accounts, and you're just aligning and isolating every single account to its specific risk vertical. So transactions stay in line with the risk appetite of the banks, and this means if one of these accounts goes, which are seen as higher risk, you're still keeping your operational cash flow in line because the second layer still works, and most importantly, your treasury is not lost and you're still having all of your money in your tier 1 bank accounts. So and here's the move that will change everything. So if you have transactions coming in from these higher risk industries or jurisdictions and they're landing in a high risk bank, they don't really need to keep sitting there. You can now send them to your layer 2 or layer 1 accounts, so your safer or your operational accounts, because an internal transfer is seen as lower risk by a bank. Because if you send from one business account to another business account, the bank assumes that it comes from your own company and therefore the other bank has already seen where it comes from and checked the origin, and there's just less requirements when it actually hits the account. So let's say $100,000 transfer from a crypto exchange to your own bank account triggers immediate response and scrutiny, and most banks will actually look into that and want documentation. If your pattern then doesn't really match the profile that they want, it gets flagged and you typically get off-boarded. However, if you accept these 100,000 into the right bank that is comfortable with crypto, and then from there you're sending it to your tier 1 bank, nothing will happen. Of course, you still need to have the proofs in case they ask you a question where those funds come from, but they will not off-board you because you haven't really broken their risk appetite. So source of funds documentation still applies, obviously, if there's an escalation, but it's about clean routing and matching the risk profile of each bank to the transaction and keeping these accounts open and having a longevity in your banking structure. So everything which I've just described here means that you still obviously need to keep all of these proofs when you're running your business. So you still need the invoices, you still need to have the right proofs, you still need to have the documentation of your source of wealth. But what it basically does is it just saves your accounts that are the most important from being closed, and it keeps your business running, and you're not getting into that situation where your operational accounts, or worse, your treasury accounts, get blocked and you need to remove the money and your business stops immediately. So in other words, this is the operational difference that keeps your main banking relationships alive while you're actually moving substantial sums through riskier channels, yeah? This architecture absorbs the friction that would otherwise destroy a single account and would lead to a problem. A lot of clients are surprised and when they hear that because they think they have nothing to hide. And unfortunately, it's not even about hiding because you don't do anything bad. It's simply that banks, they see you as a higher risk, especially if you're not making that much money for them. And then they want to offboard you, and it's about protecting yourself from that and not because you're doing something illegal or your business isn't worthy. And I know you probably don't want to hear it, but at Redomiciled, for the structuring and for the banking, we do things properly. And unfortunately, this is the level of organization that you need nowadays in 2026 to actually keep a global business running and keep your global structure running as well. And again, this doesn't mean that you're doing something wrong or that you're hiding something. It's simply about longevity in the banking system because there's only a limited amount of banks that there are, and you don't really want to burn them because you can't get an account later on again. Now, there's other things you can do as well in order to diversify. So, for example, if you want to layer some privacy into this architecture, you can use a US structure to have certain advantages when it comes to privacy. So, America, for example, doesn't participate in the CRS, the Common Reporting Standard, which means that there's no automatic exchange of information within 120 countries that are in the CRS, which means that whatever you do in the US with your US company and your US banking stays private. So this means you can use a US structure for a part of your business and run some transactions via there, but you could also use a US LLC for holding some of your private treasury in there and basically using it like a personal structure. You can open business accounts that I just mentioned or interactive brokers, and that gives you another layer of diversification. So, of course, the US is a very well-regulated market, so you're not hiding any money, but you're just diversifying it from other jurisdictions like Europe, where you think there could be maybe some more implications in the future, and the US doesn't really listen to them anymore, and this is why it could make sense. So for that, you need the clean documentation. You need an EIN, you need formation papers, an operating agreement. We help clients with all of that. And you need a business website. But residency isn't really important. So that means the CRS advantage remains intact even if you're operating outside of the US. So this means you can benefit from being in a fully regulated market with amazing access to financial products and also to financial services and like brokers without having to be from there. And you can actually get access to better institutions like you could in Europe. So of course, this is just another example like I've just mentioned before, and they are very simplified. But when clients come to us, we typically build these tailored approaches for their banking and for their structures with them, depending on who they are, what they want to achieve, and what their business does. And this is just another example of what you can do if you want to, for example, have access to better financial institutions in the US or more privacy. And there's obviously a lot of these things that you can do in order to have the best structure in place. So I want you to have one key takeaway from this video, and that is stop thinking about what is the best bank. Start thinking in a way where you are actually building like a structure across your banking, across your personal and your business structure that doesn't fail when only one account gets closed. Not one algorithm flag or one risk spike or one partner bank that changes their opinion, and then that leads to your entire structure collapsing or your business stopping. That's not what you should be doing. You should be actually asking yourself, how can you get longevity and resilience into that process, like I've just described in this video. So your immediate action after watching this video should be a self-audit. So where does your treasury sit right now? Where do you actually run operations from? What happens to payroll, client payments? Where do you have your own personal expenses? And what would happen if an account would freeze tomorrow? And most entrepreneurs realize that they're operating on luck rather than on a strategy once they actually ask themselves these questions and they do a real assessment with their own structure. So are you ready to move beyond this and to improve your structure? This was a simplified example, but we have the exact sequences for opening those accounts, for compliance documentations that different banks need, and what they're actually looking for and what their risk appetite is, as well as the transfer pricing structures that you would need in order to keep everything coordinated and legal. We've opened over 600 business accounts for international businesses and offshore structures for our clients and together with our clients. So if this sounds interesting for you, join our community or book a free call with our team to build this properly, tailored to your business or your personal structure, and that you are not depending anymore on these little changes in the banking system, and you have a system that works in the future as well.